Greetings from Dallas, Texas. I'm here at a conference and I thought I would record from my hotel suite. Yes, this is my hotel room. It's giant. You could just live here full time. It's definitely big enough for that. It's got two bathrooms, a kind of kitchenette area, all kinds of stuff. I'm in the dining room now. So it's pretty nice. I got an upgrade because there were some problems with my last room, to say the least. Anyway, I wanted to start with some good information. So mortgage holders gained. I mean, this market just will not stop. No matter what all the doom scrollers and doomsayers and chicken little sky is falling people say, it just keeps chugging away. It's amazed a lot of people. Mortgage holders gained $1.6 trillion in equity last year to reach an aggregate of $16 trillion, the highest year-end total on record, 2/3 of which is held by borrowers with credit scores of 760 or higher. So you can see, as we've been talking about for the last over a decade, that the loans that have been made coming out of the Great Recession have been strictly underwritten. They have been very good, very high quality borrowers. So nothing to worry about there like it was the last time around. I mean, this is just a completely different type of market, a completely different type of situation than before. The average mortgage holder now has $299,000, so $300,000 in equity, 193,000 of that, which is considered tappable, meaning they could borrow that money out of the property if they wanted to. That money is available. It could be withdrawn while still maintaining a healthy 20% equity stake. That's an 80% LTV if they pulled out almost $200,000. Now, the question I always ask is, what aren't they telling us? What are they not saying here? You can't hear the dogs that don't bark, right? Well, what are they not saying here? They're talking about mortgage holders. They're not talking about the 42% of the country that owns their house free and clear. So again, it's massively better than what they're talking about because those people have 100% equity in their properties, right? So really, really good. Let's look at these credit scores in a little more detail. Now, these are the mortgage originations, and they show the credit scores of those borrowers at the time of origination. So there are very few low credit score mortgage originations. During the housing bubble, the Great Recession, many of the low credit score loans were made through private labeled securities markets, right? And, we talked before about Louis Ranieri, who in the early 80s changed the world and definitely changed the mortgage market in the United States massively by securitizing mortgages. Look for the prior episodes on that. You can just go to jasonhartman.com and type in mortgage-backed security, Louis Ranieri, whatever you want, and you'll hear all about him because he is an important person in this massive change in how mortgages are done in the US and also around the world to a smaller extent. This guy, just nobody talks about him, right? But really important player in this market for mostly better, but for a few reasons, sometimes worse too. Okay, so these are the number of low credit score mortgages on this chart. These meaning 660 FICO or below, right? How many people had those? Well, as you can see, during and leading up to the Great Recession, it was a giant, giant number, over 4 million. And this is, every year, right? If you do the compounding effect and you take, give or take 4 million of those people per year for 4 years running, essentially, you have 12 million people with loans they shouldn't have received, right? These are the ninja loans, the wired loan, the loans that they shouldn't have been able to qualify for. And then just in 2007, I mean, it's amazing how this just didn't stop as everybody was starting to see the problems. In 2007, over 2.5 million of those loans. So over 15 million of these loans, right? And then in 2008, almost 1.5 million loans underwritten with FICO scores below 660. Really, really irresponsible. How about last year? Last year, this number of borrowers totaled only about 350,000 out of a housing market that has grown substantially since then. So remember, these numbers on the chart are not showing you the relative numbers as they should be, right? They're not showing you compared to what? They're just showing you overall numbers. And as such, the housing market is much bigger now. So you compare that 350,000, give or take, loans with these low credit scores underwritten last year to a housing market size of 140 million, and it's a drop in the bucket. And what this doesn't tell you, right? What else doesn't this chart tell us? It only talks about credit score. It does not talk about the underwriting for income, for assets, for money in the bank, et cetera, just strictly FICO score. So again, a lot more to it than meets the eye most of the time. Okay, the US economy started 2024 the way it ended 2024, with a huge number of new jobs. 353,000 new jobs in January, following 333,000 in December. Even better, wages are up and are outpacing inflation over last year. So people are having real gains. Of course, this is with the consumer price index. It's based on the CPI, the CPI. So with real inflation, maybe the gains aren't so great, but at least officially, right? Those gains are real and they're quantifiable compared to the other years where the gains have not kept up with inflation. But what doesn't this tell us? Why is this happening? Well, I don't think you can give the current administration any credit for this. What you can give credit for is the fact that this year we have a record number of people, the most ever in history, turning 65 years old. And as such, this is constricting the labor market. And this shortage of labor is going to last for many, many, many years. So with that, we will continue to see a strong labor market for quite a while. That is the likelihood, as the shortage just persists because of the demographics. People are aging out of the workforce and they are retiring, and there's just not enough people to replace them. My generation, the Gen Xers, didn't have enough children. The baby boomers didn't have enough children, and certainly the millennials are not having enough children. So this labor shortage is likely to persist for a very, very, very long time. And that will keep wages high. It will put upward pressure on inflation for a long, long time. And this is just going to be a systemic issue because of demographics, which are very, very difficult to influence or change. All right, be sure to register for the cruise. That's the other thing I want to say. Our upcoming Empowered Investor Cruise. Go to jasonhartman.com. It's right on the front page there, and get your tickets for the cruise. 5 nights, 6 days. It's going to be a wonderful time, and a lot more people are registering here. So I know everybody waits till the last minute, but get yourself a ticket. You'll still be able to register later, but the rooms will be subject to availability, and the pricing all changes because our room block on the cruise ship, on the beautiful Celebrity Apex, the brand new beautiful Celebrity Apex cruise ship, our room block will expire in the near future. And when that happens, everything is just subject to market rates. Okay, so go to jasonhartman.com, get a ticket for the cruise.